to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Ms. Medenijs, Tax Technical Coordinator at IBFD, and with me for a Beyond the News interview is Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. On today's show, the Director of OECD's Center for Tax Policy and Administration, Pascal Saint-Amand, expresses optimism about reaching consensus, but not by July. India breaks new ground with its significant economic presence criteria for corporate income taxation, and wealth taxes seem to pay off, as Argentina collects millions from its once-only wealth tax, and the US state of Washington enacts a capital gains tax targeting the rich. These and more, including Stuart Gibson's interview with Tom Roesser, Tax Policy Counsel at Microsoft in Washington, D.C., coming up on IBFD's Tax Takes. First, we turn to the top news of the past week as reported in IBFD's Tax News Service. Speaking at a widely viewed webinar last week, Pascal Saint-Amand, Director for OECD's Center for Tax Policy and Administration, shared both optimism and realism on whether the members of the BEPS Inclusive Framework will be able to reach consensus on how to address the tax challenges arising from digitalization of the economy. On the one hand, he welcomed the new forceful approach of the Biden administration and is prepared to be optimistic. But on the other hand, he acknowledged that timing is the challenge, conceding that it will probably take until October to iron out all the details. Meanwhile, the business community is not yet fully on board. During that same webinar, Tim McDonald, Vice President of Global Tax at the global consumer products company Procter & Gamble, acknowledged that his company is willing to support some of the reallocation of taxing rights. But he also warned that P&G will not seek political support in most countries for a radical change from current practice. It remains to be seen whether the OECD's optimism will prevail. As the OECD works to reach consensus on reallocating taxing rights to market jurisdictions, India is already moving ahead. In 2018, India added the concept of significant economic presence to their corporate tax laws to determine non-residents' taxable income. Now, India has made it clear that the significant economic presence of non-resident business is triggered when the business interacts with at least 300,000 users in India, or exceeds an annual transactional threshold of 20 million rupees. Seems like India may have beaten the OECD to the punch. Argentina has just released the results from its once-only wealth tax, and they are staggering. Out of an estimated 13,000 taxpayers who are subject to tax, about 10,000 paid the taxes, remitting to some 223 million pesos to the Argentine treasury. The government will audit 900 non-filers as non-compliant. But they shouldn't break out the Prosecco quite yet, as many who paid the tax are challenging the levy in court. As more and more governments target the wealthy for special treatment, the US state of Washington could not resist the trend. Last week, for the first time in its history, the state, which does not impose its own income tax, enacted a capital gains tax targeting high-profit investments. Set to take effect next January, the new law imposes a 7% capital gains tax on the sale or exchange of stock, bonds, and other assets, where the profit exceeds $250,000 in a year. Just like with the Argentine wealth tax or other taxes targeting the rich, opponents of the tax law have challenged the new tax in court. Washington's governor, however, is confident that the law will survive legal challenges, arguing that it's both fair and constitutional. The courts will have the final says. A number of years ago, Brazil adopted an amnesty program under which delinquent taxpayers could pay up, avoid jail, and keep their identities a secret from local tax collectors and the public at large. Rejecting a challenge from the Brazil Socialist Party, the Supreme Court of Brazil has ruled that the law prohibiting the government from identifying those who sought tax amnesty did not violate the Constitution, The court added that the amnesty regime promotes a more efficient policy for combating foreign exchange evasion. In Brazil, at least, it's worth keeping a secret to promote better compliance. And now moving on to other news. Countries are moving in opposite directions when it comes down to addressing the economic challenges associated with the COVID-19 pandemic. Ghana has introduced a 1% COVID-19 health recovery levy on all goods and services, and Afghanistan will implement its 10% VAT 1 year earlier despite previous delays. Moving in the opposite direction, Saudi Arabia has promised to lower the current 15% VAT rate to a rate between 5 and 10% within the coming 5 years, while Turkey announced a temporary reduction in VAT from 8 to 1% on overnight lodging services. Then, over the past few years, the IRS has aggressively targeted non-compliance by taxpayers who own and trade cryptocurrencies. The biggest challenge has been identifying those taxpayers in the first place. One effective tool at the agency's disposal is a John Doe summons, through which the IRS can compel a third party to identify taxpayers the IRS may not know about. Last week, a judge in San Francisco authorized the IRS to issue a John Doe summons to a local digital currency exchange to identify taxpayers who did at least $20,000 in cybercurrency transactions. Traders in crypto are finding it harder and harder to hide from the taxman. In a court case over paperwork, the Danish Supreme Court ruled that the transfer pricing documentation provided by Tetra Pak was so incomplete that Tetra Pak could not adequately prove that the tax authorities' estimates were based on an incorrect or deficient basis. Therefore, the court saw no basis to override the tax authorities' discretionary increase in Tetra Pak's taxable income. So I guess the lesson for this week is make sure you have your paperwork in order. And now we go beyond the news for Stuart Gibson's interview with Tom Roesser. Stuart?
Thank you, Esme, for your informative news report. I'm Stuart Gibson, Chief Editor of Global News here at IBFD. Joining me today is Tom Roesser, Tax Policy Counsel at Microsoft in Washington, D.C. Welcome, Tom.
Hi, Stuart. Thanks for having me today.
It's great to have you here with us. Before we jump into a discussion of digital taxation in the OECD, Tom, could you please briefly explain what your role is at Microsoft?
Yes, I'm a general manager and a member of Microsoft's Tax and Trade Department leadership team, which manages our department. Among other issues, on the tax side, my team is responsible for monitoring worldwide tax policy issues and is also responsible for global benefits taxation.
Sounds like quite a portfolio there covering the whole world. Well, here we are in May 2021, just months before the deadline that the OECD set for the members of the BEPS Inclusive Framework to reach consensus on how to address the tax challenges arising from digitalization of the economy. The current plans involve two pillars. Put simply, Pillar 1 would reallocate taxing rights over so-called residual profits from producer countries to consumer countries, and Pillar 2 would create some form of global minimum tax. And the OECD is negotiating to roll back or eliminate digital service taxes imposed by countries like France, unilateral measures as part of an overall agreement. Last month, the United States offered a proposal to narrow and simplify the scope of Pillar 1, impose a robust minimum tax under Pillar 2, and require the rollback of the unilateral measures imposed or proposed, with the caveat that the U.S. would not accept any plan that discriminates against U.S. businesses. So Tom, tell us, where does Microsoft stand on the Pillar 1 blueprint and the current Pillar 1 efforts, including the U.S. proposal?
Thanks, Stu. So let me start by noting that we have been supportive of the OECD Inclusive Framework effort since day one. While many key political and technical issues must be resolved, we support efforts to negotiate a sustainable, binding agreement based on taxing net income that does not discriminate against any industry or country. We believe it is important for countries to negotiate and reach agreement on which taxing rights they will assert and which taxing rights they will give up. We favor simple and consistent rules that provide predictability and certainty for taxpayers and tax authorities, minimizes tax disputes, and minimizes double taxation. During the OECD Pillar 1 consultation last January, we shared our perspective on many issues. We applauded the inclusive framework's focus in the blueprint on reducing complexity. As the OECD and others have observed in various contexts, complexity increases cost, reduces certainty, undermines stability of the system, and interferes with growth. However, the blueprint guidance is often not clear on the principles informing the proposed rules. Simplification, while an important objective, is not a principle and should not automatically override the proper application of existing tax principles that are still relevant to the Pillar 1 computation. Complexity also interferes with the ability to achieve consensus. We were concerned last January that the Pillar 1 blueprint is overly complex and suggested refocusing and limiting amount A to appropriate operating margin percentage of a business's remote sales to third parties booked outside a market with a commensurate reduction in income allocated to surrender states. We believe focusing on multinationals' remote sales booked outside a market eliminates complexity and disputes relating to consumer-facing businesses versus automated digital services and further broadens the base. The U.S. proposal to limit the scope of businesses subject to profit reallocation under Amount A to the largest and most profitable companies would eliminate significant complexity and controversy regarding what is and is not a consumer-facing business or automated digital services. However, the U.S. proposals raises some interesting issues that may be of interest or concern to Congress. For example, if the idea is to limit Amount A to the most profitable 100 or so companies, will Congress agree if the profit pool to be reallocated to market jurisdictions is disproportionately related to U.S. businesses? Pascal Saint-Amand of the OECD recently noted that approximately 500 billion euros of profit of these 100 companies could be subject to reallocation to market jurisdictions, if I understood him correctly. How would this impact U.S. businesses and the U.S. fisc? What if national champions of other countries are excluded? How is profitability determined, and would such determination create competitive distortions? The U.S. expressed an openness to addressing nexus issues with small countries. How does that reduce complexity, and will other countries surrender revenue from those profits to market jurisdictions, even though the market jurisdictions had nothing to do with value creation? During the consultation, we noted our view that Amount A must include a ceiling for reallocation to markets where the multinational already had a physical presence, and additional profits should not be reallocated to the market if the market is already being compensated at or above the OECD agreed amount. It is important to address the double counting issues. As I understand it, the marketing and distribution safe harbor under Amount A is intended to address this issue, and the Biden administration is also interested in alleviating this double taxation. Regarding a proposed Amount B fixed baseline distribution return consistent with the arm's length principle, we commissioned KPMG to conduct a fact-based economic analysis, which found that regardless of industry, geography, or profitability of the companies, the arm's length return for sales, marketing, and distribution activities are within a fairly narrow band, a median of 2.5% for limited risk distributors and 3.6% for value-added sales, marketing, and distribution activities. Amount B will not provide any certainty in our view if the fixed percentage is too low and market jurisdictions revert to asserting that additional revenue is due to the jurisdiction because of additional functions beyond Amount B performed by the local market affiliate. While we support the inclusion of an Amount B fixed baseline marketing and distribution return consistent with the arm's length principle, if it is too difficult to reach political agreement on the Amount B rules within the desired timeline, then we suggest focusing on concluding an Amount A agreement. It would be interesting to learn from policymakers whether Amount B is still being discussed and whether they can reach political agreement on a fixed distribution return. Thanks, Stu.
That's a mouthful, Tom.
Yeah.
And it's a lot to have to for the inclusive framework members to ponder over the next few months. So where does Microsoft stand on the developments on Pillar 2, and particularly the U.S. proposal on a global minimum tax?
I think it's clear that Republicans and Democrats have vastly different perspectives on corporate and international taxation. Obviously, the Biden administration proposed to increase the corporate rate to 28%. which combined with the state and local rate would make the U.S. corporate tax rate one of the highest, if not the highest, in the developed world. It appears that Congress may believe this will cause competitiveness issues, and some don't want to go higher than 25%. With enactment of GILTI that only allows 80% of foreign tax credits, U.S. businesses are already subject to U.S. tax when selling into foreign jurisdictions, while their foreign competitors are not subject to additional home country taxation. The question is, why would Congress agree to further disadvantage U.S. businesses by increasing the GILTI rate to 21%, especially since other countries are unlikely to go down this road, since they were previously rumored to be discussing a 12.5% or so global minimum tax rate and under tax payment rule? I just think time will tell.
Time will tell. The real question then becomes whether the members are sufficiently invested in reaching an agreement that covers both pillars. The countries that for whom Pillar 1 is important versus the countries that believe that Pillar 2 is more important to them, to try to reach some sort of agreement that includes whatever they need to reach a comfort level for their particular country and the businesses in their country. It sounds like there's a lot more work to do from what you've said. I was going to ask you what elements Microsoft would like to see in the final version of the pillars. You've already given us some detail. Is there anything else you'd like to add on that?
No, we think agreement, a high-level political agreement, can be reached by mid-2021. We'd like to see an agreement that includes several key points. On Pillar 1, a multilateral agreement should not disproportionately target particular industries or businesses from a particular country. As I mentioned, I don't think the U.S. Congress would go along with something that targets U.S. businesses while excluding national champions of other countries. We believe the quantum and reallocation percentage should be set at an appropriate level to limit the reallocation to essentially non-routine marketing and intangible returns, and not allocate trade intangible returns that would discourage R&D investment and value creation. We think the agreement must not create competitive distortions in the market, and the segmentation rule will be important. Any agreement must prevent double counting. If a business is already compensating a jurisdiction at or above whatever the OECD inclusive framework decides, additional profits should not be reallocated. As such, it is important to include a viable marketing and distribution safe harbor under Amount A. We also think any agreement must also include clear rules and determination of which country or countries will surrender the profits being reallocated, with clear dispute prevention and resolution mechanisms that balance taxpayer protections and tax administration concerns in a defined time period. Also, any agreement must include the withdrawal of tax provisions that bear the hallmarks of unilateral measures at the time of agreement, rather than at some uncertain implementation date in the future.
That sounds like a comprehensive list of where things ought to go. I was going to ask you, because outgoing OECD Secretary Angel Gurria had implored stakeholders when the blueprints were released last fall to reach consensus, and the predictions were dire consequences for the global economy and chaos in the world of international taxation if the countries don't reach agreement. I think that the consensus as to whether OECD, the members of the BEPS Inclusive Framework would reach agreement by this summer has varied depending on what time of day it is and who's just gotten done talking. What are your views about where things stand now? You expressed some optimism that a political agreement could be reached. What would be the best outcome for Microsoft from what's going on now?
Yeah, so once again, we think we're supportive of the OECD Inclusive Framework efforts and believe a high-level political agreement is possible in mid-2021. An optimal solution would be a sustainable binding agreement based on taxing net income that does not discriminate against any industry or country, does not allocate away innovation, does not create market distortions, provides relief for businesses that already compensate market jurisdictions, minimizes double counting and double taxation, includes a clear, timely, and administrative dispute prevention and resolution mechanism, and withdraws proposed and current unilateral measures. So there's a lot in there. There's a lot to do. They're making progress, and once again, I think time will tell.
I agree with you. Time will tell, and it sounds to me as though Microsoft has laid out a series of criteria that could serve as a guide for reaching agreement, if not by this, at least a high-level agreement this summer, and perhaps more detail by October, as Pascal Saint-Amand suggested during the Oxford webinar last week. Tom, I just want to thank you. Our guest today has been Tom Roesser, Tax Policy Counsel at Microsoft in Washington, D.C. Thank you so much, Tom, for sharing your valuable insights about where Microsoft is on this issue that I'm sure is critical to your business, your users, your shareholders, your customers, including me.
Thank you, Stuart.
That wraps up this week's edition of Tax Takes News and Views, the week's tax news in a nutshell. From Esme Denise and myself, thank you for watching. Here's hoping your week is not too taxing.